Good day, guys. Welcome to Forex Walker. Welcome to episode 72. Now, in this episode, we are going to be talking about economic divergence. And in economic divergence, for this is the pound and the cat. Hope you can see these two boys here. So, for economic divergence is to happen is that we expect the pound macroeconomically to go bullish and the CAD macroeconomically to go bearish. So that forms what we call the economic divergence. The further those two currencies diverge from each other, one going up and one going down, the more you get paid, and that means the more pips you make for those who trade pips. So the further they move, the more you get paid. And for this trade to fail, what the opposite needs to happen. Now, let's say for now, let's say the pound decides that, nah, I don't want to go all the way up. I would rather move sideways. I would rather move sideways instead. Now, when the pound moves sideways, the CAD is still collapsing, and the further the CAD collapses, the more you get paid. What happens when the CAD keeps collapsing and the pound is moving sideways? The direction for the market here in the pound CAD will be an uptrend. See? It'll be an uptrend, but the pound is not gaining strength. The reason why the market is moving higher is because the CAD is getting weaker. So, uh, because the CAD is getting weaker, it looks like the pound CAD is moving bullish, but it's not the pound that is gaining, it's actually the CAD that is getting weaker. So for this trade to fail, the opposite needs to happen, which is that, let me show you what the opposite will look like. We talked about the pound moving sideways. So if the pound is moving upwards, we're making more money. If the pound moves sideways and the CAD keeps collapsing, uh, we'll still make money. The market will still go bearish. However, if the opposite happens, for the trade to fail, the opposite needs to happen. The pound needs to collapse all the way down, and the CAD might rather say, uh, I don't want to sell, I want to move sideways. Now, when the CAD moves sideways, what happens is that it might drive this whole thing to move sideways instead. It might drive this whole thing to move sideways because the CAD is not getting weaker, it's moving sideways, is actually strong, and the pound is getting weaker. So for the trade to fail, this will still it might not be that much bullish, but it might be something like this, which is a sideways move, a general sideways move, or perhaps let me show you something else. We're talking about a failing trade now. For this whole thing to trade, I apologize for that. For this whole thing to fail, the cat has to say, I'm not moving sideways, actually, I'm gaining strength. Now, when the opposite happens, what will happen is that the pound CAD will go down. It'll go all the way down. And that's how you get your stop loss hit and the whole trade fails. I think this is the guy I'm looking for. Where is he? Trend. I'm looking to open a position. I had not used these things in a long time. So your stop loss gets hit, the market moves all the way down, and this being your stop loss, it gets hit. So for this trade to fail, the complete opposite has to happen, and the CAD has to gain and the pound has to collapse, which makes it difficult for, I mean, if this would be normally when this happens, it happens because the macroeconomic reports are coming in at opposite times. Like another currency becomes bullish this month, and the other currency starts gaining strength. I call it uh, when you take in trades and those currencies are getting bullish at different times. But if you have an alignment in time, you can actually catch those trades. But if the you have a misalignment in time, you won't be able to catch the economic divergence in between the currencies. But eventually, the trade will actually move in your direction. Unfortunately, if the time in economic divergence happens at opposite times, then you might lose the trade. So for this thing to fail, it becomes highly impossible for an economic divergence. What I'm trying to say is that using the macroeconomic divergence system, it makes it easier for you to trade because your job is just to hold the currency and wait. So I normally take one trade in a month or one trade in a quarter. So I'm not expecting to take too many trades. I spend a lot of time waiting for a trade to take its course. And because of that, uh, I would rather look more into the economic releases between the two currencies and observe whether the economic releases are aligned so that the opposite does not happen. But for as long as I have my time in alignment between the two currencies, then I can filter all of those uh, miss economic reports and know which currencies to hold. Because I, using macroeconomics, you cannot say this month I'll be buying the pound. Why are you buying the pound? I don't know. I just feel like I want to buy the pound, and that's how you lose money. But if you allow macroeconomics to choose a currency pair for you, then you can actually align your time and be able to hold those trades. So uh, I don't know if I was able to explain this economic divergence properly for you. Not good with teaching, but let's move into the real thing and leave all those zigzag things doing what they're doing. So let's talk about price action first. Price action. Those who talk about first touch, second touch, third touch, manipulate, collapses, never comes back. First touch, second touch, third touch, manipulates, never comes back. So here we have another replica of that. We have a first touch here. Hope you can see it. First touch here, this body. Second touch here. Third touch manipulates. I hope you can see it. So sorry about that. So those are the three touches that we had. The third touch manipulates, and the market took off on the it actually took off here. And these purple lines are the previous shoulders that were not tapped into. This is the first previous shoulder, the second previous shoulder here. And you can see that this second previous shoulder was actually tapped into. You could have set your buy stop here on the 23.6. This is the 50% fit where it was rejected from here. It was rejected and the market came back to the 23 on the previous shoulder. That's how I trade. And we actually displayed this beautiful move here, and we went all the way on the third manipulation touch, and the market rallied. Okay, it did not rally, but it will rally because we have okay, the long term economic outlook on the pound is bearish. So this is a short term pullback in economic divergence. That means what we were pricing in on the previous term here had reached an end. We're expecting a pullback. Now that pullback might happen all the way, might pull back. I apologize for that. This pullback might reverse from here on the last order block here. I For those who understand order blocks may start from up there, but this is the last order block before the drop, and you can see how beautiful that drop is. So it tells you that this is the last order block. So the market might come back to the previous order block here and reverse all the way down there because the pound is generally bearish in its directional bias, or we can look into holding it all the way up there. So what we do is that we move our stop losses uh, to wait for the market to do its thing. Or the market can actually come back to the previous shoulder here and collapse all the way down. So that could be something like this, where you get back to the previous shoulder and do your thing. Let me remove this thing and show you what I'm saying. I apologize for my clumsiness. So what we're expecting is that the market might have went all the way down there. Let's say it's the 50% sweep all the way down here. And we come back to the previous shoulder and we sell. So this is the picture that we're trying to paint. So at the moment, we are in this pullback here, this macroeconomic exchange in time intervals, like the selling, the pricing in of sales on the previous quarter is done pricing in, and we're looking for a pullback, that which we are buying at the moment. And after that pullback, we are looking for another sell, the pricing in of the next of this fourth quarter that is also selling. So the sales are not going to end here. They might as well go all the way down to a previous order block that might be here. I don't know where that order block will be, but we might get something like this. And the lending, remember, we're trying to pull back so that we can buy. The economic reports on the pound are going to be bullish in the future, not now. However, for now, we're pressing in some sales in two conservative quarters. So this is the tiny bull move. That's why I call it a low yielding trade, where the cat will be collapsing and this tiny bull move will be taking over. Nobody knows where it will turn around. That's why you need to move your stop loss to break even. And if the market reverses, it reverses and it stops you out into profit. So when you have a trade like that, let me show you the trade. When you have a when you enter a trade like this being the entry level, and having a stop loss like that, and you have a pullback like that, you need to keep moving your stop loss higher and higher so that you are risk free. So on MT5, you're able to move your stop loss manually like that. And when the market gives you a pullback, it stops you out into profit. So all of this is your profit. And you can keep moving your stop loss like that until the market decides to reverse. So this is the trade that we have on the short-term side of it. And with the long-term side of it is bearish. That means the currency will be selling. And for now, we are buying this tiny move. And I'll show you the progress in the pound cat. Thank you guys. I will see you on the next episode. Goodbye.